You don't use a hammer for every repair, right? Sometimes you use a screwdriver, sometimes a spanner. Same way, you cannot use the same spread for every market condition. So let's figure out which one to use when so that your trades don't fall off. Hi, I am Pranav VK, your spread strategist here at Stockshala by Kotak Securities. So far, we have discussed the different kinds of spreads. But now in this video, we'll compare each of them one by one so that we get to understand which one to use when. Let's head to the whiteboard so that we can compare all these 4 strategies in a tabular format. So here, I have mentioned all the different spreads that is possible, their maximum profit, maximum loss, time decay, and view as well. In fact, you can go ahead and take a screenshot of this so that you never have to think about it once again. So let's start analyzing this from the favorite spreads that I have. I love the bull put as well as the bear call because they are net credit spreads, whereas bull call and bear put are net debit spreads. So starting with bull put and bear call, both of them have maximum profit, which is the extent of the credit received. And the maximum loss is nothing but the strike difference minus credit, which is the same for both of them. Time decay is positive, which means with time, if the market is in your direction or if the market is range bound, you're going to make more and more money. And the view for this is either the market is sideways or bullish or bearish, depending on whether it's bull put or bear call. Now going to the net debit spreads, the maximum profit is nothing but the strike difference minus the debit for both of them, and the maximum loss is the debit paid, which is basically the premium that is paid. Time decay is negative, which means the more time you stay in the specific spread and the market is not going in your direction, then you're going to lose more and more money, which means the view for this is moderately bullish if it's a bull call spread and moderately bearish if it's a bear put spread. Debit spreads lose value with time if nothing else moves in the market, whereas credit spreads make money if nothing else changes in the market. So let's understand in which kind of volatile situations can we use each of them. Use net debit spreads when the volatility is low and you expect it to rise, because as a net debit spread, you want the premiums to rise, and with increase in volatility, the premiums are going to increase. Use net credit spreads when the volatility is high and you expect it to drop, because when the volatility reduces, the premiums generally tend to fall, and that is exactly what you want in a net credit spread. Now let's take an illustrative example and try to guess which spread would make the best choice for us. To start with, Nifty is at 19,500. We also observe that there is high put OI at 19,400. Resistance is at 19,600, and IV, which is implied volatility, is high, which is 22%. Now in this case, which spread would make sense? Pause this video and try to make a guess. Were you able to guess which spread would make sense? Don't worry, I'm going to clear it out for you. Now let's analyze each of the parameters. Right now, the market is at 19,500. And we can see high put OI at 19,400, which means this is acting like a support. And there is resistance at 19,600. So resistance at 19,600, support at 19,400. And IV is high, which is 22%. So what did we just learn? We just learned that we have to use net credit spreads when the IV is high and we expect it to drop. So since IV is high and 22%, and since there is support and resistance right above and below the present market price, the market is expected to be range bound or slightly bullish because of the high put OI. So which means we are going to first finalize that we're going to choose one from the net credit spreads, that is either bull put spread or a bear call spread. Since put OI is high at 19,400, it would make sense for us to sell something that is just below the current market price. And hence, we can go for a bull put spread where we are going to receive the credit. Our maximum loss is going to be the strike difference minus the credit, time decay is on our side. So the view is also bullish or sideways. So this is going to be my bet for this specific illustration. Now let's take another illustration and test if you actually understood what we have learned so far. So in this illustration, Nifty is at 20,000. There is high call OI at 20,500. The resistance is again at 20,500 and the IV is low at just 10%. Now go ahead and pause the video and analyze which spread would make the most sense for this illustration. I want you to do this activity sincerely because if you understand this concept clearly, then trading in options will become smooth sailing. Did you find the right answer? Let's find out. So here, Nifty is at 20,000 and there is high call OI at 20,500, which means call OI represents resistance. So there is resistance at 20,500 and again, price action resistance is also at 20,500 and there is low IV. So in this case, we can see that clearly the market might be bearish, which means we should also look at both the bearish strategies. But since the low IV is just 10%, in this case we know that if the IV is low and expected to rise, then we have to go for a net debit spread. So now we know we have to go for a bearish strategy and a net debit strategy, which means we clearly know that we have to go for a bear put strategy, wherein our maximum profit is strike difference minus debit, our maximum loss is debit paid, time decay is negative, but we are moderately bearish. So let's quickly recap what we have learned so far. We have understood, most importantly, that between choosing a net credit spread and a net debit spread, volatility plays an important role. So if volatility is low and expected to rise, then we should go for a net debit spread. But if volatility is high and expected to drop, then we should go for a net credit spread. We also learned that net credit spreads are equivalent to option selling strategies, wherein the probability of profit is going to be much higher compared to a net debit spread, which is equivalent to an option buying strategy. And finally, it's important for us to know what are the break-even points for either of the strategies, and depending on the market view and the direction, you have to choose the right kind of spread. So if you got more clarity on which spread to choose for your options trading strategy, then go ahead and comment below which strategy that you would use if the market is bullish. Also, share it with your friends who's confused between bull spreads and bearish spreads. I'm Pranav VK and you're watching Stock Shala by Kotak Securities, and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.